This video provides an overview of the major concepts covered in Chapter 20, Bank Performance. A commercial bank's performance is examined by several stakeholders such as bank regulators, shareholders, and investment analysts. Commercial banks also evaluate their own performance over time to determine the outcomes of previous management decisions so that changes can be made where appropriate. Chapter 20 includes 3 learning objectives. First, to identify the factors that affect the valuation of a commercial bank. Second, to compare the performance of banks in different size classifications over years. And third, to explain how to evaluate the performance of a particular bank based on financial statement data. Let's start with the valuation of a commercial bank. The value of a bank is essentially the present value of its future cash flows as modeled here, where E, CFT, represents the expected cash flow to be generated in a future period T and discounted at a rate of return required by investors in the commercial bank, K. As such, the value of a commercial bank should change in response to changes in its expected future cash flows and to changes in investors' required rate of return, as represented by this expression. The change in a commercial bank's expected cash flows can be modeled like this, where Econ denotes economic growth, RF is the risk-free interest rate, Indus measures the prevailing bank industry conditions, and MANAB represents the abilities of the commercial bank's management. Economic growth can enhance a commercial bank's cash flows by increasing the household or business demand for loans. During periods of strong economic growth, demand for loans tends to be higher, which allows commercial banks to provide more loans. Because loans tend to generate better returns to commercial banks than investments in treasury securities or other bank securities, expected cash flows should be higher when they make more loans. Another reason cash flows may be higher is that, in general, fewer loan defaults occur during periods of strong economic growth. Interest rate movements may be inversely related to a commercial bank's cash flows. First, if the risk-free interest rate decreases, other market rates may also decline, which may result in a stronger demand for the commercial bank's loans. Second, commercial banks rely heavily on short-term deposits as a source of funds, and the rates paid on these deposits are typically revised in accordance with other interest rate movements. Changes in industry characteristics that can affect a commercial bank's cash flows include regulation and technological innovation. If regulators reduce the constraints imposed on commercial banks, the expected cash flows of banks should increase. Technical innovations can improve efficiencies, which can also lead to improved cash flows. Of the 4 characteristics that commonly affect cash flows, the only one over which the bank has control is management abilities. A bank's managers can attempt to make internal decisions that will capitalize on the external forces that the bank can't control. As the management of a skilled commercial bank improves, so should its expected cash flows. The rate of return required by investors in a commercial bank can be modeled as follows, where delta R represents a change in the risk-free rate and delta RP is a change in the bank's risk premium. When the risk-free rate increases, so does the return required by investors. Recall that the risk-free rate of interest is driven by inflationary expectations INF, economic growth Econ, the money supply MS, and the budget deficit DEF. If the risk premium on a commercial bank rises, so will the rate of return required by investors in that bank. The risk premium can change in response to changes in economic growth, industry conditions, or management abilities. This exhibit provides a framework for valuing commercial banks. In general, the valuation is favorably affected by economic growth, lower interest rates, a reduction in regulatory constraints, and an improvement in the bank's management abilities. Many publicly traded banks saw their valuations decline by more than 70% during the 2008-2009 credit crisis, which was mainly attributable to the decline in housing prices that led to decreased market valuations of the mortgages and mortgage-backed securities held by the banks. Cash flows generated by mortgage-related securities were reduced substantially because some of the mortgages were expected to default, and many banks offloaded some of their holdings of mortgage-related securities on the secondary market, but had to sell them at a discount because of the concerns about future defaults. In addition, the weak economic conditions reduced the demand for loans by qualified borrowers, as well as the demand for other bank services. As a result, investors recognized that the banks were more susceptible to failure during that period and required higher risk premiums. The next major concept in the chapter is assessing bank performance. This exhibit illustrates how the general performance of a bank is summarized, based mostly on income statement items, and offers insight about a bank's income, expenses, and efficiency. Each item in the exhibit is measured as a percentage of assets, which allows for easy comparison to other banks or to a set of banks within the same region, and allows for an assessment of the bank's performance over time. Gross interest income is interest income generated from all assets and is affected by market rates on the composition of assets held by the bank. Gross interest income tends to increase when interest rates rise and decrease when interest rates decline. Gross interest expenses represent interest paid on deposits and on other borrowed funds, both of which are affected by market rates and the composition of the bank's liabilities. Gross interest expenses will usually be higher when market interest rates are higher, but will vary among banks depending on how they obtain their deposits. Non-interest income results from fees charged on banking services provided and is usually higher for larger banks because they tend to provide more services for which they can charge fees. Non-interest expenses include salaries, office equipment, and other expenses not related to the payment of interest on deposits. The loan loss provision is a means by which a bank can account for anticipated loan losses or defaults on its income statement, so it offers useful information about the quality of the bank's loans. Securities gains or losses results from the bank's sale of securities. They're usually negligible for banks in aggregate, although an individual bank's gains or losses can be significant. During the credit crisis, securities losses became more pronounced as banks in general suffered losses on their investments in mortgage-backed securities. Analysts and investors alike rely heavily on the bank's financial statements to evaluate a bank's performance. Banks have a thorough internal reporting process that they're supposed to follow to ensure accurate reporting. However, there could be considerable subjectivity in accounting for items such as loan losses, which causes a lack of transparency and can create much uncertainty when assessing banks. During weak economic periods, investors may not know whether they can trust that the banks have fully acknowledged the reduced valuations of their assets. The last concept in the chapter relates to evaluation of a bank's return on assets. Net income measured as a percentage of assets is known as the return on assets, or ROA. Net income and ROA as a result are affected by the various income statement items and the policies and other factors that affect those items. This exhibit identifies some of the key policy decisions that influence a bank's income statement. It also highlights some factors not controlled by the bank that affect the bank's income statement. This exhibit identifies the factors that can affect a bank's performance as measured by ROA and ROE. A bank's ROA can be negatively impacted by a number of factors, including low interest received on loans and securities, high interest expenses related to funding sources, insufficient non-interest income from supplementary banking services, heavy loan losses, or excessive non-interest expenses such as overhead and advertising. An alternative measure of overall bank performance is ROE, or return on equity, which is affected by the same income statement items that affect ROA, but also by the bank's degree of financial leverage. The leverage measure is simply the inverse of the capital ratio. The higher the capital ratio, the lower the leverage measure, and the lower the degree of financial leverage will be. For a given positive level of ROA, a bank's ROE will be higher if it has a lower capital ratio and more financial leverage. This relationship explains why managers of banks tend to prefer to use a high degree of financial leverage. However, when they use a high degree of financial leverage, banks hold less capital to support their assets, which leaves them exposed to more risk. If a bank using a very low level of capital experiences a large loss, this could wipe out its remaining capital, causing it to fail. This exhibit shows the average annualized return on equity among banks over time. The ROE was relatively high during the 2005 to 2007 period when the U.S. economy was expanding. However, it declined substantially during the credit crisis, even reaching negative levels in 2009 and gradually increasing over time as the effects of the crisis subsided. The ROE dipped during the COVID-19 crisis in 2020, but recovered quickly afterwards. Let's explore this a little deeper with an application example. This exhibit depicts the performance characteristics for Zager Bank and the industry over the last 5 years. Because Zager Bank is a medium-sized bank, it's compared here to other medium-sized banks. Zager Bank has used an aggressive management style of providing loans to borrowers that might be viewed as risky given their limited collateral and their cash flow situation. The bank charges high interest rates on these loans because the borrowers don't have alternative lenders. It also charges these borrowers high annual fees after providing its loans. During strong economic conditions in years 1 and 2, Zager's strategy was very successful. It achieved a high net interest margin and high non-interest income, and the borrowers typically made their loan payments in a timely manner. However, when the economy weakened in year 3, many of the borrowers who received loans from Zeger Bank couldn't repay them. As a result, Zeger was not able to extend many new loans because the demand for loans declined. Although other banks also experienced weak performance when the economy weakened, Zeger Bank experienced a more pronounced decline in its performance because it had more loans that were susceptible to default. The exhibit shows that net income declined for medium-sized banks in general during year 3, but it actually turned negative for Zeger Bank because of its large loan losses. This example illustrates the risk-return trade-off for Zeger Bank. It was rewarded for its risky strategy when the economy was strong, but it was severely penalized for that strategy when the economy was weak.